Good morning. Good morning. Today is Wednesday, November 25th, and we are the day before Thanksgiving here. So that always presents a kind of interesting setup in the markets. I think we've talked a little bit before here about how holidays often get in the way of the options expiration calendar. We have a particularly confusing one this morning because, or I guess I should say this week, because on Friday we have a half day. So the markets can't be closed for more than 4 days in a row. It's this old weird thing where they want information to hit the markets as fast as possible. Now, I know that seems a little antiquated in a world where everything's totally 24/7 electronic, but back in the day, SEC did not want the markets to be closed for 4 days in a row. So we're going to be trading on Friday. What that means is we see some really bizarre effects in overall implied volatility, both with Friday being a half day, with people taking time off. This afternoon, we expect to be relatively slow. Markets aren't doing much today. So I'm going to share my screen and pull up sort of some of the things that I'm looking at here today in the markets. So I will share my trade hawk. Futures are very flat this morning. Let's see where SPY is. Down, about 7 points, sitting right around 362. We've been at all-time highs here, so it's not too surprising to see us give up a little. The Qs are trading up $1.40. So some additional technology bullishness. But what do we do in this implied volatility environment? And I want to kind of pull up a historical volatility chart to kind of go through what we should be looking at and thinking about here. So I want to show, let's get the historical vol up first, and then this 30-day IV. So where I'm really focused on the curve is out over here. We've long talked about how coming out of the election, there's all kinds of declining volatility, and we've really seen things come in quite a bit here. And that's that point right there. So that's the beginning of November, but we keep going down. So this leak just continues to happen as the market is grinding higher. So that makes a really difficult environment to trade options, because if you're long options, you feel like they're just going to sit here and decay in your face. However, if you're short options, you don't really have that much actual premium in your options to sell and make the sales worth it. So, I think a good example, let me pull up here. I got to get my mouse back. And let's pull up, just a 2-day out option in the Qs. So at 296 right now, this is the options expiring on November 2nd. So here, let me get that up. So, for just 2 days, we have a straddle in QQQ that is trading, I'm looking at the straddle, sorry, at 296. So this 296 at the money straddle is trading around $3. So ironically, that actually is a decent amount of movement that we'd see. We moved the $1.50 today, but do you really think between this holiday and Friday, we're going to see that kind of move? That's a tough straddle to sell at $3. We could easily see that kind of move in the market here. So it makes it uncomfortable to want to be short volatility, but it also, is difficult to be buying volatility. So again, I think this is a really good argument why we want to always use spreads when we're setting up positions. So, even going out to December, our same straddle that we're looking at here is around 13 and a half, a little less than 13 and a half. So, that's actually quite a move out to December if we're talking about a $13 move in the Qs. So we actually are still seeing a bit of that bid in volatility, a 22 vol level out in December. And, if we go all the way out, we're actually seeing a little bit higher vol in that Jan Feb space. That's sort of the interesting calendar effect that we're getting here, is that vol out in Jan and Feb is in the 24 range, whereas in the near term, it's much more compressed, closer to 2021. The holidays are always difficult to trade. Great time to spend with your family, but it can be difficult to trade. So, if I were to look at a scenario going out to December, to capitalize on something in the QQQs, a limited risk trade structure that might give you some opportunities would be to lean a little bit bullish here. And I'm going to sell 2 of these maybe to buy one of these and buy one of these. Give myself a little bit, I want to sell 2 of these to buy one of these, to buy one of these. And this is a nice defined risk trade that we're looking at here. So, we're able to short a little bit of volatility. We're able to lean into a little bit of longness, but really cap our downside. Markets can be really slippery around this time. So I like having this defined downside all the way down here, per contract, that's only $60 to make 36 if we continue to rally. If the markets sit around here, going through December, we have a nice max profit up there at 124. These defined risk kind of trades really let you manage the low volatility, expecting lower volatility, but lean into some of that potential drift, because a theme that we continue to talk about is what this reduced volatility environment is going to do to the dealers that are hedging this on the other side of your trades. So to the extent that the dealers have a position that is going to get shorter and shorter deltas as volatility comes in, they've been selling stock against their short puts. They've been selling stock against their short calls. So as the volatility on those comes in, the deltas are also going to come in, and their dealers are going to be left with all this additional short stock, and they're going to need to buy that to cover it. So that's what we call Vanna, and that's what we might see cause the market to slowly kind of grind up over this sort of Santa Claus rally period. If that volatility actually does come into where we expect, then we are going to see a bullish drift upward also. So a really interesting trade structure here in the Qs to take advantage of potentially, an end of year rally that is fueled by some of this volatility. Again, to sort of recap here, we sold 2 of the 296s. Get a little highlight here. So we sold 2 of the 296s at about 650. We bought 1 of the 297s at $6. And we bought 1 of the 294s, so 2 strikes down on that. That's that sort of broken wingedness that we've got. So we paid $7.68. Overall, this trade, we're going to put on for a debit of around 70 cents. Hopefully we can get that a little bit better. That was the current offer, 70 cents. Wide-ish markets here, so something to pay attention to. As always, execution matters. Get that spread off around 65 cents, and we have some really interesting profit opportunities should the Qs kind of sit here and decay through the holidays, or fuel that bullish rally. So always interesting and important to have different exits on your trades when you're looking at them. Defined risk, know your plan, and that is the way to successful trading. Check us out here every morning at 8:35, 9:35 Eastern, 8:35 Central. You can also follow us on Twitter at harvested_DAF. We're putting out lots of interesting stuff there. We've got some volume and open interest analysis. You'll find links to our resource center, and additionally links to our upcoming webinars. So a quick plug for our upcoming webinar next week. We'll be talking about our model portfolios next Tuesday. So I'd encourage everyone to tune in. It'll be a great dissection of trades just like this, and we'll show you how Harvested Financial can manage your option strategies for you with just the simple click of a button. You have a set it and forget it model portfolio that really harvests the power of options for you. Thanks so much for tuning in, everyone. Have a wonderful Thanksgiving, and we'll catch you next week.